Good afternoon. This is Arlan Suderman, Chief Commodities Economist with INTL FC Stone, and we're here for this week's, this month's, WASDE update to talk about USDA's crop report that came out earlier today, and it was full of surprises. The August crop report is known for its surprises, and USDA didn't disappoint. So we'll try to go through those and kind of highlight what the significant surprises were and what that does to our perspective as we go forward and the implications of those numbers. First of all, though, I do want to talk about the broader markets and the money flow and the impact of that, because I think in the end that's going to play a factor in how we eventually end up responding to these crops. Price is still a function of supply and demand, but it's modified by the flow of money. And so we want to talk about the current conditions under which that money flow is viewing these supply and demand fundamentals. We start with the weekly chart for the dollar index, and you'll see, though, on the right-hand side of this chart how we broke sharply below that trend line, broke below support, but still held above the old 2016 low. This is a critical area for the dollar to hold here in the days ahead. If that holds, and of course we have the 200-day moving average just below this market, then you would expect to see the dollar start to bounce off of that level, and we'd start to look for the news that might support that, one of which would be the Fed, but also what's happening in Europe, since the euro is one of the major competing currencies in the dollar index basket. If, on the other hand, it breaks through that 200-day moving average, breaks below that 2016 low, then there's a lot of open territory below this that the dollar could fall. Will it? I can't say for sure. I don't know that. But it does leave it vulnerable from a chart formation standpoint, which many traders, in fact, most traders pay attention to and give respect to. That historically has been good for the commodities. When the dollar is weaker, it has been more of a problem for the commodities when the dollar is stronger. So this is a factor to watch going forward. Excuse me. Now, the CRB index, here again we talked about, heavily weighted toward the energy sector. As you see outlined there, 23% crude oil, 39% overall to the energy sector. It created a bottom, and I want to highlight that here on the chart if I can. It created a bottom in late June that was above the 2016 low. That's critical, and we're going to talk more about that here in a little bit, but then it trended higher and has broke through the top of the short-term descending channel. It stays short-term. That's since the first trading day in January. So that's a significant positive technical development that we see at this point. Now, if we break it down in a daily chart, that was a weekly chart, we narrow it in and focus on that, we see that that late June low put in a bullish island reversal and gapped higher a couple times, trended higher, broke through that downtrending channel line that we pointed out. And so this is looking fairly constructive. Now, we are trending a little bit lower here of late. That looks like it may be a more of a bull flag that we're trying to rally out of, but here again, time will tell. It's one of the things we're watching. That would seem to say that we have a more favorable outlook for the commodity sector as a whole and how the funds view the factors. I'm backing up now a chart. If, in fact, on this weekly chart, we see this rally continue and then take out the 2016 highs, that would be generally more positive for the commodity sector. Keep in mind that we're not talking about a robust bull market here. Those tend to be very slow in developing and gain momentum over time. We're talking about over years rather than over days. So we're talking about the very beginnings of more of an inflationary tone toward the commodity sector here as a backdrop. Here in the continuous commodity index, here again, this is a weekly chart. We see something similar there. Here's the daily chart. Here again, very similar type. The continuous commodity index is more equally weighted among the various commodities. And so even though it is not heavily weighted toward crude oil, we still see some very similar dynamics at work here in this as well. Now, let's talk about, in that light, let's talk about the data that came out this morning. I'm going to start with the wheat here and kind of get this out of the way. My apologies to those in the wheat sector before we focus on corn and soybeans, simply because the surprises were more so in corn and soybeans. So I want to talk about wheat first, and then we can focus on corn and soybeans. Note that all wheat crop came in at 1.739 billion bushels. That's 28 million bushels above what the trade expected, even though it was down 21 million from what USDA indicated in July. So from that standpoint, it had a bearish slant to it. I wouldn't call it all that bearish. Our estimate is actually at 1.716 billion, a little higher than the trade, but here again below USDA. Winter wheat, no real surprises there, just a little bit bigger than anticipated, and I'll show why here in a little bit. Hard red winter wheat, pretty close to what we were expecting, pretty close to what the trade expected. Same thing with soft red winter wheat. White wheat came in bigger than expected. The USDA is expecting us to see much bigger white wheat, and this is white winter wheat here. USDA expecting to see much bigger exports of white wheat going forward and drawing those stocks down, and I'll show you that graphically here a little bit later. Hard red spring wheat, now this is a critical market where we saw the big movement, and we may see more movement on September 30th. Don't look for any real move in the September WASDE report. USDA is expected to wait until September 30th small grain summary before it makes additional adjustments. USDA dropped basically about, 60 million bushels off the hard red spring crop in this report, down to 364 million. This is not other spring, this is hard red spring, not counting the white spring. I was looking for 382, the traders at 393. USDA did not change harvested acres. I knew that they didn't like to do that in August, but based on the reports that we're seeing and our observations from our people in the region, we felt like the abandonment or making hay out of the wheat instead of grain was so big that they wouldn't have much choice but to make another adjustment in this report. They did not. I do expect that in the September 30th report. So I do, and you'll see that on my balance sheet a little bit later, but I do expect their acres, the harvested acres number, to come down a little bit more. Now, when they do that, maybe they'll adjust the yield upward, or maybe not. That's always a question mark with USDA, but for now, that's where they're at. And Durham came in a little bit lower as well, pretty tight stocks there. As we look at winter wheat yields and what changed in this report, basically we saw soft red winter drop. The only hard red winter we saw go down was in South Dakota. And South Dakota just has had a really bad year this year all the way around, and they pulled another 5 bushels off. Other than that, the reductions all came in the soft red winter wheat areas. As we look, and here's the adjustment in the winter wheat, look at the, what do I want to say, head weights, the weight per head. We saw a modest increase in the weight per head, and we saw an increase in the heads per square foot. So USDA adjusting both. Now, head weight is a calculated value. It is not measured in this survey. So keep that in mind. Overall, though, USDA is saying there's a little better head population than what it found in the July report. They were basically in the same fields, counted things a little bit different, statistical variation from one report to the other, but that gave us the increase in production on the winter wheat. Oh, excuse me, I stand corrected. This is total wheat. This is total wheat, not just winter here. On spring wheat yield, we saw that the yield dropped in each of the, well, in the Dakotas, Montana, and in Washington. It went up 5 bushels in Oregon, unchanged in Idaho and in Minnesota. Now, we'll talk about corn and soybeans. USDA pegged the corn crop at 169.5 bushels per acre, down from 170.7. Interesting how they called their trend yield 170.7 in May, and then in the data, the support data for this report, they put out a graphic that showed 169.5 as being their trend yield. Soybeans, 49.4. Their trend yield is 48. That's where they were last month. That's where they've been all spring. They come in 49.4. In explaining this 100, well, I'm going to start with soybeans first of all, because that's the easier one to, well, I was going to say easier one to explain, but easier one to deal with. How about if I say that? The trade, and I would agree with this, the trade and the industry who we surveyed, knowing that the bulk of the soybean, what determines the yield on the soybean crop comes after USDA was walking the fields the 1st of August. It comes in the month following that. And not just walking the fields, but surveying farmers. So when Commodity Weather Group did a survey of other similar analog years, and they found like 7 other years, I believe it was, they found other years that had similar crop condition ratings, similar rainfall for the Midwest, and similar temperatures. They saw final yields anywhere from 16% below trend to 5% above trend in those years. That would be the equivalent of basically anywhere from 40 bushels to 50 bushels per acre. Huge difference, huge range, and that's because yield is determined in this month following when USDA is out in the field to determine for this crop report. So the expectation was that USDA would come out with something close to trend until more is known, but if there was a bias, it was a little bit of bias to the downside, not much, a little bit of a bias though, because roughly 1/3 of the Midwest is under significant moisture stress at this time. The crop is smaller in stature. Now it can pack a lot of pods on that smaller crop, but it is smaller in stature, and we do have widespread herbicide volatility issues, shall we say, in the core of the Midwest. And so that's why the bias is slightly below trend. USDA comes out with something that's almost 1.5 bushels above trend. Do I have a problem with the 49.4 bushels per acre as a final yield? No, that's very possible. We could be even higher than that. We could match last year's yield. That is still very possible. Or we could end up at a 45 bushel yield. It's just a surprise that USDA did the 49.4 bushels per acre in this report. And I think when you look at what we know of their methodology, it's just very puzzling how they could have come up with that number. But it is what it is, and it has to be traded and it has to be respected because it is very possible. It is very possible, as I said, that we could even repeat last year's yield, 52.1 bushels per acre. And so therefore we have to respect this number, and it is very possible. And what this number does is communicates to trade that possibility of a higher yield must be respected. But will we end up with a 49.4? There's no way of knowing. And here again, the safest bet was probably a trend yield around 48 bushels per acre, but it is what it is. Now, that gives us a crop of 4.381 billion bushels, which is, about 160 million above what the trade was anticipating. And so certainly in about 150 million bushels above what I was looking for. Let's talk about corn now, the 169.5. It's been the understanding of the trade that USDA was using a model for its August crop report that it outlined in a white paper published in 2013. And if you use what that model defines as its parameters for determining yield, excuse me, it would suggest by our calculations that the yield should have come out around 167, 167.5. So we did not expect USDA to come down as far as the trade was at a little over 166, and certainly not as far low as what we are for our final yield estimate based on our most recent survey, 162.8. We did not, though, expect it, nor very few expected it to come in with a 169.5. Now, it came out in USDA's Twitter chat that they did not use that model that I just described, but instead they depended upon objective yield data and their farmer survey. Now, 2 issues with that. Their objective yield data for the bulk of the Midwest Corn Belt would have been with immature crops. USDA did admit that its ear weight, which I'll show you in a bit, ear weight was modeled and not measured, as you can imagine, because of the lack of maturity of the crop on August 1st. It just finished pollinating. Much of the corn was in the blister stage at best. Some had not even pollinated on August 1st. And so the 169.5, okay. So objective, that covers the objective plots that they would have looked at. All it would have given them kind of is population counts, and that's about it. So now let's look at the farmer survey. And I know we have a lot of farmers on this call, and so I want to say this respectively, that from our observations and what we've heard, and I interact with a lot of farmers, most farmers were not in the fields yet on August 1st. They were driving by their fields, and they have just this week started going into the fields to do yield checks. Now, what we've been hearing is anecdotal, so that may not prove to be fact in the end, but the anecdotal that we've been hearing to this point from the major producing areas of the Midwest are, wow, when we walked into the field, it was not as good as what we saw from the road. So does that mean that this yield estimate goes down in September? Or does it go up from here? Well, that's the big question mark. I've told you what we're hearing and what we see and what our industry survey showed, our client survey, which has a pretty good track record. The question now is, what other information comes out from this point? And there's two factors that will play into that. First of all is the Pro Farmer Crop Tour, which is the week of August 21st. That will be critical, I think. Here, first of all, the crop will have another 3 weeks of maturity on it, both corn and soybeans. And second of all, it is a systematic walk through the fields going across the Midwest. So it gets you away from just a little bit of this anecdotal reports. You get more of everything, and so you get a better picture of the variability of the crop. So that should give us a lot of ground truth this year. I normally have a lot of interest in this tour and what comes out of it in years when we have a big crop to see just how big the crop might be, or a small crop, we see just how small the crop might be. But this year, I'm really looking forward to what comes out of it, because I want to see what is said, what we learn about the variability of the crop. But our current sense is that we're still sticking with the 162.8 for final yield, and then we'll survey again on September 1. And then the other factor I was going to say is September crop report. By the time USDA is in the field September 1st for the September crop report, we'll have a lot more maturity in the crop. They'll be able to rely much more heavily on the objective data, which will mean more then. And the farmers will also know a lot more that they survey as well, simply because more time has passed and they will have been in the field. But these are the numbers that will be traded. These are numbers that were traded. And the fact that we ended up near the session lows today suggests that the market for now believes these numbers. We'll see if we get a bounce tomorrow overnight. But let's move on. Change from the previous year, the bulk of the Midwest, obviously a smaller crop from last year's big record, the exception being Michigan and Nebraska and Ohio, with yields up from last year. When we look at the implied ear weight, and again, this is a modeled ear weight, the third highest on record. So what this tells me is that this USDA crop report did not address the pollination issues that we are seeing be a significant problem in key production areas of Iowa and Illinois, as well as other parts of the Midwest as well. And so obviously you've heard my bias in this. Soybean yield, this is a drop from last year, virtually all the Midwest with the exception of Missouri, down from last year, Missouri unchanged. Of course, last year was a big crop. It just not down as much as what we thought. Ending stocks, wheat, 933 million. I'm still looking for something smaller than that. Corn, 2.23 billion bushels. Obviously, that's 270 million above the trade and well above where our final estimate at 1.6 billion. Soybeans, 475 million bushel for ending stocks. USDA projects this is new crop, of course. That's about 50 million above what the trade was looking for, even though USDA raised its export target by 75 million. Interesting. Now, I've told you almost every time we've been on this webinar, USDA is famous for being very good at underestimating demand. But it was interesting in this report when they had this big surprise increase in production that they increased exports to 75 million bushels. So I looked at their global balance sheet and say, okay, who did they reduce exports for? Nobody of note, nor did they adjust the usage to adjust for it. So the math doesn't add up. It certainly has the appearance that they simply pushed exports up, not because of conviction of demand from China, which is strong and which they continuously underestimate, but it certainly makes the balance sheet look a lot better. So that is something we're going to have to watch, particularly if, and that's that if again, particularly if the crop does turn out to be as big or bigger than what USDA says, and that is still a possibility. Global ending stocks, largely because of the adjustments that USDA made in this report, are higher for corn, soybeans, and wheat, although there were some other adjustments in wheat as well. So bigger stocks, lower prices, that's the reaction we saw first with the algorithmic traders, the computers, followed by the human element as well. Now, a couple of key areas that I think we want to continue to focus on is this area right here in central Illinois that was under stress when it pollinated. The Pro-Farmer Crop Tour doesn't always dip down that far into this area, so that's something we want to watch, see how far they dip down in the eastern leg of the tour. The other area of concern is over here in the western Midwest, where I think we'll see significant problems in the corn crop there. Be watching, listening for the tour results of what they see in the way of pollination issues there. Corn Condition Index score here as of this week, you see it here versus the same week in each of the last 30 years, and then the blue line is what the final yield ended to be in that year. We're noting here that the red line showing the Condition Index score on a week-to-week basis, trailing just below the 10-year average, this darker blue line, showing a lot of similarities to 2011 right now. I also have 2001 in there because that's one of the analog years from a condition standpoint, but the correlation in the condition scores has not been as significant thus far, but I do have it on there to monitor and watch. When we look at state by state or state yield models, and you see the R-squared values on the right, and that gives us an idea of how much of that state's yield is being demonstrated by the condition scores to this point. And the higher the number, obviously, the better. So we get lower R-squared numbers on the state models than we do the national. The national, we're up to around above 0.9 in most states now or close. And we end up at about 0.97, 0.98, depending on talking corn or soybeans, so pretty close. But the state is a little bit lower. It does give us a little bit of a modeling of where we're at. But notice how many states are still above trend in their yield estimates. Now, will we end up there? I don't know. Here again, this is the first year of our state model, but the key there is Iowa down 4.5 bushels per acre. You see where we're at versus where USDA is at on these various states, and it does make for interesting discussion. But I did want to point out, we still do have a lot of good corn out there. It's just that we believe there's enough problem areas to pull us sufficiently below trend to have us closer to that 162.8 level. Soybean index scores you see there, we've pulled the scores you see in the bottom graphic. We've seen the scores rally the last couple of weeks. Where will we go from here in the weeks ahead? That's the big question mark in determining yields going forward. And here again, you see in the state yield models that the majority of states are still basically at or above a trend yield, just that we didn't expect that high of a yield overall. And we see back up on the corn, of these 18 states, major producers, a state-weighted composite yield would be about 168. On soybeans, it'd be about 47. So here again, another surprise for us on USDA's number. So put it all in the balance sheet. Here again, the left-hand column is what we're looking at for our current projection as the most likely scenario. That includes that yield of 162.8 on USDA's current planted acreage, current planted acreage, 9.9 million acres. That may see some adjustments after the FSA data just came out while I've been here. I don't put too much confidence in the August FSA data, a little bit more confidence in the September numbers. But we may see USDA adjustment that acreage over the next couple of months, but for now that's what we have. And so I'm looking for ending stocks of $1.6 billion, which would argue for a marketing year average cash price of $435. If, in fact, we do get the 169.5 bushels per acre, that would suggest, in my terms, on my balance sheet, I have a little bit more demand there, 2.063 billion bushels, marketing year average cash price of $335. Not that much different from this past year. On the other hand, if we drop that yield to 158, which seems a long ways away now after this crop report, still possible, not likely. If it's likely, it'd be in the left-hand column. But that would be just below 1.3 billion bushels and argue for a marketing year average cash price of $475 per bushel. So obviously, based on this, it's my sense this would suggest that the market is underpriced if, in fact, we're right on the yield, but that's the big discussion. Soybeans, I have ending stocks at 446 million. This is new crop on a yield of 47.7. That's our company yield. Now, on the corn, my bearish scenario, I went with USDA's 169.5. I did not do that on soybeans because I still believe it could go higher or it could go lower. There's too much time to go in determining soybean yields. So if I use last year's yield of 52.1, I end up with ending stocks of 735 million bushel. Excuse me, there's nothing bullish about 735 million bushels. Marketing year average cash price of $830. If we don't finish the year well, the late month or even mid-month rains don't develop, and we drop that yield to 45 bushels, which is still possible as well, then we drop ending stocks to around the 250 million bushel range, marketing year average cash price at 1065, with futures likely spiking significantly above that. So, excuse me, a lot of different varying possibilities for soybeans yet. As we look at the soybean condition, this is spring wheat condition scores. We did see a little bit of bounce, and we're seeing the top chart this week, but still the bottom chart shows these ratings are the second lowest in history, but there's some similarity to 2006. And in that year, we saw the final yield drop down closer to the 33 range, although the trend was much lower than what it is this year. As we look at the wheat by class, soft red winter wheat here again has the biggest problems with just a lack of demand to consume the surplus bushels that we have, with basically what is that, almost a 9-month surplus, 8.5 month or so surplus of soft red winter wheat. Hard red winter wheat not looking so good. I was really surprised. I expected USDA to raise its hard red winter export target, and it has not. I think the potential is there for that to happen. I look for at least 25 million more bushels of exports than USDA, maybe more depending on what final crop sizes are in Germany, Canada, and Australia, the key places we're watching. But overall, hard red winter wheat stocks, the demand is improving, but we're still looking at a 6-month surplus. So we need to see that export demand continue. That means prices not getting ahead of things. It is competitive right now, so we need to move it out, start moving the firmer bids upstream into the interior. Hard red spring, USDA cut exports more dramatically than what I would for hard red spring. I do think we'll see hard red spring stocks end up a little bit tighter than what USDA has them here, but this is where they're at right now. Put it all together, you can see that I have a 45.9 bushel yield, which is a little bit higher than USDA, but my harvested acres is still considerably lower because of the adjustment I expect in the spring wheat belt on September 30th. So that's why my ending stocks are now at 873 million bushels. I did want to show you the results of our latest survey and our Twitter survey. So this is social media. Upper left, will corn prices be higher or lower than the current levels in 6 months? And of course, these survey results were from prior to the USDA for the most part. 74% of those responding said they expect corn prices to be higher. And so that shows the bias going into this report that corn was underpriced, and I would dare say we'd probably get similar results if we were to ask that again after report. Soybeans, not as much confidence there, I think, because there were still too many unknowns about what the size of the crop would be, but still more people believe that they'll be higher 6 months from now than didn't. What percent of the new crop corn in your area is priced? 42% said less than 10% of the corn in their area is priced. 28%, 11 to 20% of it. So here again, we've got a lot of room, a lot of corn that yet to be priced, let alone the old crop corn that's still out there. What percent of the new crop soybeans in your area are priced? There we're seeing a larger amount of it. 20% is in that 21 to 30% range, 23%, 11 to 20, 29%, greater than 30% is priced. And so here again, the scales between these two surveys are much different, so keep that in mind. Less than 10% of the soybean crop priced at 28% versus 42% for corn. Now, take-home points. Well, I'll just say the August corn yield estimate lacks logical support, and the soybean yield estimate lacks even more logical support, in my opinion. Although the soybeans I could see happening eventually, I could see that happening. We simply don't know. Could go either way yet. I do expect lower corn yields in September at this point, but I'm going to be paying a lot of attention to that crop tour coming up in another 10 days or so. Soybean yields could end up either higher or lower. A crop tour and some of the other crop tours going on takes on a whole lot more importance here over the next few weeks. Commodity indices still have a bullish bias. Follow the money. Once we stabilize these prices and we maintain this bias toward the broader commodities, we could very easily see that provide support for this market. But right now it's bearish. Right now they're selling, and we got to stop the bleeding first, because right now they're trading chart signals. So that's what we got to respect and pay attention to. And with that, I'll open it up for questions. Go ahead and submit your questions. Hopefully some have already. And Jake, I'll let you go ahead and read off the first questions as they come in.
Thanks, Arlan. We'll just give it a second.
Well, we're waiting for the first questions to come in. I do want to thank you for participating once again. We've just had great response to these webinars, and we really do appreciate the questions and the feedback and response as well. We like it when it's two-way, when it goes both ways. We have that feedback, and we do appreciate that, and we hope it's been beneficial to you as well. So, waiting for your questions now. Maybe we explained it well enough, Jake.
No, we got a question, Arlan.
Okay, excellent. There's a few in there that I count on every time, so go ahead. Ryan has a question.
Is NASS being transparent in their methodology year to year?
That's a sensitive question. I would say since we found out they did not follow the model in coming up with today's yield, and we did not know that until after the report came out and the trade had traded it, that is a lack of transparency. There have been other times when they have been forthcoming and said, we are changing the model, changing our methodology, and they told us ahead of time. So I'm going to give them the benefit of the doubt that that communication was an oversight or the lack thereof. But for this report, I would say there was a lack of transparency. We now know how they did it. We can debate the validity of how they did it, but at least we now know how they did it.
David has a question. If the USDA soy production ends up correct and Brazil still plants big, how low could you see beans going during the coming year?
Oh, I hate to ask that question, because in this advent of billions of dollars of fund money coming in, how low or how high doesn't have any limits really. But I will say that once the charts turn positive or negative, doesn't matter which way it is, and they get some momentum behind them in that direction, the money will chase it as far as it can until something proves it wrong. Having said that, the demand is strong, but the supply, if in fact this number is correct, or it's either correct or even bigger than that, the supply will be adequate to meet that. And what we are seeing as we talk to our team in Brazil is an expectation toward more soybean acres this coming year. And if the weather is favorable and we continue to build on stocks, then we could be looking at prices $2 to $3 below where we're at. That is very possible. Having said that, and it's something I neglected to bring up in the webinar, as we look at the early projections for summer in South America, we do have, as you look at the analog years, a higher than normal risk of dryness in southern Brazil and in Argentina during their summer growing season. It's still below 50%, but not far below 50%, so it is a significant risk. That forecast is based on an assumption that, if I got it right, that the waters in the southeast of the Pacific will remain warm. I hope I got that right. It's not cool, but I think it's warm. But there are some models, there's two major models, and one of them has those waters being warm and the other cool. Commodity Weather Group, in calling for the forecast which I already gave you, was assuming that they would stay warm. The other model calls them to go cool, and there is some validity behind it. And so if, in fact, those waters do flip, then what that does is that moves the dryness all into Brazil. Argentina's wetter, but the bigger acreage is in Brazil. So all of a sudden, instead of South Brazil being dry and North being wet, so they can kind of offset each other, you have all of Brazil potentially dry and lower yields. So the risk is higher. Obviously, we've seen similar forecasts for the U.S. Last year is a great example where the forecast models in many cases were calling for hot, dry weather at the end of the summer, and it never developed. So it may not be, but there is risk there that we'll have to be watching. But for now, what we know, ample supply, and that gives the funds the freedom to push prices lower and keep pushing, keep trading that momentum until proven wrong. So we have to respect that risk.
We have a question from Bev. What do you expect corn basis to do into the fall in northwest Iowa?
Tell me what the final size of the crop is going to be, Bev. Yeah, I do appreciate your question, respect it, and I do have to say that the way we're structured under Dodd-Frank, I cannot make predictions on price, and so we're walking a little bit of a sensitivity issue on basis, so need to be careful about that. But if, in fact, if you're in northwest Iowa, you're in one of the problem areas from a production standpoint, and you know that. If, in fact, we do see the yields move in the direction that we expect, then I would expect that basis to firm, because farmers will start getting bulled up and be slow on moving it Now, it depends. Obviously, if the board rallies sharply, captures and we get this big flat price rally, then the farmer goes ahead and dumps. But at this point, if in fact it moves in the direction we think, we would anticipate seeing a little bit more firming in there. Certainly does weigh, and we see other areas of the Midwest in a similar type of situation.
That looks to be all of it, Arlan.
Okay. Well, we want to thank everybody for participating once again this month, and follow the crop tour. Follow me on Twitter at twitter.com/Arlan, A-R-L-A-N, FF101. That's F as in Frank 101. And we'll have results on there as well. And we hope to continue with you, and looking forward to the September crop report and when we'll be talking again. Thank you.